Hi everyone, today let's talk about some market perspective and we'll learn about the CAPE ratio and future potential returns. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So let's look at market perspective. They say the excess CAPE ratio measures how attractive stocks are compared to bonds in their different real yields. So let's learn about it. In terms of factors you should be looking at, inflation versus bonds actually getting those real yields. And they do mention here President Trump is looking at 10% minimum tariffs on all imports, 60% coming from China. Obviously, those are going to impact corporate earnings and could potentially drive up inflation, which has implications for the economy and asset valuations, potentially putting that pause on interest rates or potentially even reversing them, they say here. I'm not sure I fully agree with that, but they say it is a risk. And then the other thing, like we talked about, the CAPE, or the excess cyclically adjusted price to earnings yield. It's basically a price to earnings ratio, but it is smoothed for the business cycle and it also is adjusted for inflation. And then you have the excess CAPE yield, which is the 1 over the CAPE. And essentially this is going to give you the attractiveness of stocks compared to bonds, examining those real yields. So let's look at it. Also, they have a link here. I'll put that in the description. And they say here, historically, the higher the excess CAPE has been, the better returns for stocks relative to bonds over the next decade, or the inverse is true. So the lower the CAPE, the better return for bonds. Right now, the CAPE is quite low. You can see here in that zero range .com bubble, very, very low, ended up being a very strong return for bonds. And I've been saying this for a long time. I think the return for bonds is going to be better than stocks. I've been saying it, buy bonds. In my opinion, I've been buying bonds, or at the very least, buy equities that have good yields, like covered call ETFs or real estate investment trusts. Things of that nature are going to perform better than the broader market, in my opinion. Again, that is my opinion, and this is another data point that points to that same thesis. Let me know down in the comment section what you think of the CAPE ratio and the potential for bonds to outperform over the next 10 years, or are you still buying equities, buying growth stocks? What do you think for your investment future? Otherwise, like and subscribe if you got any value out of this video. Make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.